All eyes currently are on the Indian rupee. The currency of India is nosediving compared to the US dollar. Time and again, over the last few months, the Indian currency, ladies and gentlemen, bounces back after the RBI's intervention to ease downward pressure, but then again, nosedives. The rupee was trading at 89.16 against the US dollar on Monday, appreciating 0.35% for the day. We are talking about this week. The currency touched an all-time low of 89.48, nearing the psychological mark of 90 per dollar on Friday last week. And many experts predict the 90 mark might not be far away. The issue has also become political, with leading opposition parties rallying up against the government. But let's sideline the politics here. Let's talk economics and understand why the Indian currency has been nosediving for quite some time now. The first reason is the anticipation of Indo-US trade deal. Now, according to reports, the central bank has been selling dollars, which helped improve sentiment. Recently, RBI Governor Sanjay Malhotra said, this was last week, that the recent decline in the rupee is largely due to increased demand for the US dollar. He also noted that this pressure may ease if India and the US finalize a trade agreement. Malhotra also emphasized that India's foreign exchange reserves provide strong currency support for the currency. Now, expectations for clarity on the India-US trade deal remain unmet as of now. And with timelines still unclear, the investor sentiment stays fragile. And that is one very prominent reason for the decline of the rupee. The second one, the more prominent one, ladies and gentlemen, is the strong US dollar. Now, the dollar index hovered close to the 6-month peak on Friday. Rupee traded weakly, pressured primarily by dollar strength as the dollar index moved above $100, overshadowing the minor positive FII inflows. Now, while domestic flows offered some support, the broader momentum remains tilted towards weakness given the US dollar's firmness and ongoing global uncertainty. A stronger dollar is making investors worry and the rupee weaker. Next in line is Fed rate cut expectations. Now, according to Anuj Gupta, Director, Wealth Research and Advisory, this year rupee depreciated by 4.59% after lower expectation of cut in interest rate by Federal Reserve dollar and bond yield increased sharply and other currency depreciated. Now, markets now anticipate a higher chance that the Fed will deliver a third and final rate cut this year, which means if there is a rate cut, lending will increase in the US market and therefore dollars are moving towards that market. Last on the list, the major prominent reason is the India's trade deficit. Now, the rupee, ladies and gentlemen, has been the weakest currency in Asia this year, and any further decline could intensify foreign investors selling in Indian equities. In fact, India's trade deficit hit a record high in October as shipments to the US dropped for the second consecutive month following the introduction of 50% tariffs. On the back of a higher than expected trade deficit, net financial flows have been weaker, thereby pressuring the rupee to depreciate while the RBI has been containing the volatility, or at least it has been trying so. Now, what will happen because of all this? A weaker rupee will fetch you less from outside. As a result, it's expected that imports will likely get expensive as consumers will have to shell out more rupees to buy smaller volume of products. Now, you can have phones, certain electronic items, crude oil, gold, whatever you import from outside will likely be more expensive as long as this rupee depreciation continues. I, along with my team, shall see you in the next episode of Mint Explains. तब तक के लिए शब बखैर.